Stop what you're doing. Seriously, put everything else on pause, because what played out in the last 48 hours needs to be addressed right now. Something happened in the relationship between the Iran conflict and the paper prices of gold and silver that should fundamentally reshape how you look at these markets. And if you were one of the people watching silver touch $63 yesterday morning and your stomach dropped, stay with me through this entire video before you make a single move. Because what you witnessed wasn't a market doing what markets do. It was theater. I'm John Agg. Let's get into it. Yesterday morning, silver printed $61.76. That's nearly half of January's all-time high, gone in under 2 months. For about 2 hours, every chart, every headline, every comment section looked like the precious metals bull run was being taken out back and shot. The paper market was generating numbers that made it look like the entire thesis had collapsed. Then, roughly 2 hours before the U.S. market opened, Donald Trump posted on Truth Social that the United States had been holding what he described as good and productive conversations with Iranian officials about the Strait of Hormuz and a possible ceasefire. He announced a 5-day delay on threatened strikes targeting Iranian power plants. Oil tanked. The dollar fell. Gold ripped from 4,100 back above 4,400 in a matter of hours. Silver bounced off its lows. Then, before the afternoon session wrapped up, Iran's parliament speaker, Mohammad Bakr Kalibaf, posted publicly that the entire announcement was fabricated. Fake news engineered to manipulate financial and oil markets. Read that again slowly. The Speaker of the Iranian Parliament, in official state communications, directly accused the President of the United States of constructing a peace narrative for the explicit purpose of moving financial markets. And the Iranian Foreign Ministry backed that up separately, stating there were no negotiations and there are no negotiations. Now here's where it gets interesting. An Iranian official apparently looked at what's happening in the paper oil market and made a specific, pointed connection. The statement as reported goes something like this. They said they're aware of what's happening in the paper oil market, including firms that have been hired to move oil futures. They see the Jawboning campaign in full. And then they asked whether those firms can turn paper promises into actual fuel at the pump, whether they can print gas molecules. That phrase, print gas molecules, is extraordinary. An Iranian official just applied the exact logic that this channel has been documenting in the silver market for months, directly to the oil market in real time. The insight is identical. You can manufacture paper price signals without limit. You cannot manufacture physical molecules. You cannot print oil. You cannot print silver. The paper price is a performance. Physical reality is a fact. And if they're running this playbook in oil, what exactly do you think is happening in silver? The same firms documented to have manipulated silver futures through spoofing. J.P. Morgan's precious metals desk, whose 3 traders were federally convicted of wire fraud and racketeering for exactly this activity, operate across multiple commodity markets. The infrastructure for paper market manipulation is not asset-specific. It's a capability that gets deployed across anything that can be shorted in paper form. Oil, silver, gold. The playbook doesn't change. Manufacture paper selling pressure at technically critical price levels. Trigger stop-loss orders from retail and leveraged accounts. Create the visual appearance of a trend reversal. Cover short positions at lower prices. The Iranian officials saw it in the oil market in real time. The COMEX data has been documenting it in silver for months. Yesterday's intraday move in gold, from $4,100 to $4,400, is one of the most explicit examples of jawboning-driven price manipulation ever recorded in the precious metals space. A single presidential post manufactured a $300 rally in gold within 2 hours. Iran called it fake news. The rally partially reversed. Administration officials then walked back elements of the original statement. The pattern is completely transparent. Create a narrative. Move the market. Let it partially reverse. Repeat. The people who understand this dynamic are the ones in Kayseri, Turkey, standing in line around a block at a dealer called Kayseri Dovizeltin, correctly identifying paper-driven fire sale prices as an opportunity. While Western retail investors saw $4,100 gold and concluded the bull market was finished, Turkish citizens formed the queue down the street to pick up physical metal at an artificially suppressed price. This is the East versus West dynamic this channel has described repeatedly, but now it's documented in a single photograph. You can see the line. You can see the sign. You can see the people. These are Turkish citizens who lived through their own currency crisis. They watched the lira lose approximately 95% of its value against the dollar over the past 15 years. They understand viscerally, not theoretically, what paper currency debasement feels like at the grocery store, at the gas station, in everyday life. Those people did not panic at $61 silver or $4,100 gold. They recognized an opportunity created by a paper market performance, and they acted on it. They know from direct personal experience which one wins when paper prices diverge from physical reality. Let me give you the COMEX depository context for where things actually stand after everything that happened this week. The combined COMEX silver vault is sitting at approximately 332 million ounces and declining. The registered pool, the metal that can actually be used to honor delivery obligations, is at roughly 79 million ounces. May 1st notice day is 37 days out. May open interest remains in the range of 350 to 380 million ounces of paper silver. The paper to registered ratio for May is approaching 5-1 and climbing, because each day of vault drainage reduces the denominator without touching the numerator. Think about that ratio for a second. The people who sold silver at $61.76 yesterday morning sold into the lowest price of the year, a price generated by a paper market event of remarkable transparency. A presidential announcement about peace talks that Iran immediately and publicly denied. The people buying silver at 61 belong to the same category of actor who bought at the February low of 71, who bought at every pullback throughout this cycle. They're physical buyers for whom vault data is the signal and paper price is the acquisition opportunity. The battle for the $70 level in silver that analysts keep referencing is real. But understand what's actually being fought and by whom. Paper sellers are defending that price level to maximize psychological damage to retail holders and delay the moment when the May delivery arithmetic becomes publicly impossible to ignore. Physical buyers treat every session below $70 as a discount. The depository reports tell you which side is winning the battle for actual metal. Metal is leaving vaults, not arriving. The physical buyers are accumulating metal. The paper sellers are winning the number on the screen. Those two outcomes cannot coexist indefinitely. The Trump-Iran jawboning pattern is the single most important thing to understand about near-term price behavior, because it will happen again. Trump has a documented track record of making announcements about negotiations and deals that move markets, followed by denial or walkback. His own advisors have described the pattern. The Iranian parliament speaker named it directly and in plain language. The mechanism cycles like this. Escalation threat creates a fear premium in oil. Gold and silver fall on risk-off dollar demand as oil spikes above 110. Then, a de-escalation narrative produces a relief rally in equities. Oil falls, and precious metals also pull back as the safe haven premium partially deflates. Then, Iran denies the de-escalation, and the cycle resets. Each cycle produces lower lows in precious metals on the paper market, because each fake de-escalation creates a net selling bias in the leveraged paper community. But here's what the jawboning cycle cannot touch: the COMEX vault. The vault drains regardless of what gets posted on Truth Social. It was at 349 million ounces before this conflict escalated. It's at 332 million ounces today. Every bit of paper market theater, the war threats, the peace announcements, Iran's denials, has happened during that 17 million ounce drain. None of the paper performance has slowed the physical outflow, because the physical outflow is driven by industrial demand in Asia, central bank accumulation, institutional physical buyers taking delivery at COMEX, and structural supply deficit dynamics that have nothing to do with any social media post. You cannot print the 41.5 million ounces of physical silver that were delivered at COMEX in March. You cannot reconstruct the 187 million ounces confirmed to have left the COMEX system. You cannot manufacture the geological reality that produces 8 ounces of silver for every ounce of gold in the ground, while the COMEX registered vault holds them at a ratio of roughly 4.88 to 1. The gap between what can be printed and what physically exists is the thesis. Jawboning moves the paper price around the thesis. It does not change the thesis. Let me explain why 37 days to May 1st notice day matters more today than it did a week ago. And this part is counterintuitive, so stick with me here. When the paper price of silver drops, the incentive for a holder of a May-long contract to stand for physical delivery actually increases. Here's the logic. A holder who established a May-long position at current prices, say $69, now faces a choice: roll to July or September and pay the contango spread to do it, or stand for delivery, take physical silver, and with the Shanghai physical market trading at a premium to COMEX, ship that metal eastward and capture the spread between the COMEX acquisition price and the Shanghai clearing price. The lower COMEX paper price goes, relative to the Shanghai premium, the more attractive standing for delivery becomes versus rolling. Every dollar the paper sellers push COMEX silver below the Shanghai physical clearing price adds $1 to the incentive for May long holders to stand rather than roll. The paper sellers are effectively subsidizing the physical accumulation that is draining the vault and building the very delivery pressure they're trying to prevent. Let that sink in. The people queuing in Kayseri understand this intuitively. They haven't modeled EFP spreads or delivery mechanics. They simply know the price is lower than it should be, and that physical metal at a lower price is an opportunity, not a warning. They act on that, while Western investors debate whether the bull market is over based on a tweet about peace talks that Iran denied within hours. Now let me address the COMEX gold to silver inventory dynamic specifically, because the numbers from the most recent depository report reveal something almost no one is talking about. Combined COMEX gold inventory stands at approximately 32 million ounces. Combined COMEX silver inventory is roughly 332 million ounces. That's a total inventory ratio of about 10.4 to 1, silver to gold. But now look at just the registered pool. Registered gold at COMEX is approximately 23 to 25 million ounces. Registered silver is approximately 79 million ounces. That's a ratio of roughly 3.2 to 1, registered silver to registered gold. Now compare that to paper market exposure. May gold open interest represents a far smaller paper to registered ratio than May silver open interest does. The silver paper market is under proportionally greater stress relative to its registered inventory than the gold market is. That's why the silver sell-off has been proportionally more violent. The leverage community in silver is larger relative to the physical buffer. When deleveraging hits, it hits silver faster and harder. But that same asymmetry means the recovery potential in silver is larger relative to gold. The gold-silver ratio at 66 to 1 today reflects the asymmetry of the sell-off. When May delivery mechanics force a physical repricing, the recovery will mirror that asymmetry. The GSR was 42 to 1 at the January high. If it compresses back toward 50 to 1 during the May delivery cycle, with gold at $4,400, silver returns to approximately $88. If gold recovers toward $5,000 and the GSR compresses to 45 to 1, silver is at $111. Those are price targets. They're arithmetic outcomes of two variables that have documented directional momentum. The paper price is currently distorted to the maximum by the jawboning cycle, forced deleveraging, and the dollar dynamics of the Iran war. Each of those distortions has a finite lifespan. The Iran situation will eventually resolve or stabilize. The forced deleveraging will exhaust itself. The dollar's safe haven premium from geopolitical uncertainty will compress. When those temporary distortions clear, the arithmetic of the physical market reasserts. Let me give you the complete picture on what Turkey and Kayseri represent in global context, because that photograph of the Q is one of the most significant images in the precious metal space right now. Turkey lived through one of the most severe domestic currency crises of any major economy in the modern era. The Turkish lira shed approximately 95% of its value against the dollar over 15 years, moving from roughly 1.44 lira to the dollar all the way to approximately 32 lira to the dollar. A Turkish citizen who held savings in lira through that period experienced a purchasing power wipeout that is devastating by any measure. The Turks who converted savings into gold or silver rather than watching them evaporate have preserved their purchasing power through one of the worst currency collapses of any NATO member state. These aren't people theorizing about currency debasement. They've lived it. When they see gold at $4,100, a price created by a presidential tweet about peace talks that Iran immediately denied, their response isn't to question the thesis. Their response is to get in line. India and Singapore are doing the same thing. Mumbai jewelers reported record volumes when gold fell below $4,500. Singapore dealers reported sold-out inventory at the $70 silver level. The pattern across Turkey, India, Singapore, and China is identical. Populations with direct experience of paper currency failure treat hard asset price corrections as purchase opportunities, not as reasons to reconsider the thesis. The Western retail investor who sells at $62 silver is the counterparty to the Turkish, Indian, Singaporean, and Chinese buyer who sees $62 silver as a discount. Over the course of this correction, physical metal is moving from Western accounts to Eastern and Turkish accounts. This mirrors the vault data: 187 million ounces flowing from New York toward London and Asia. The paper price correction is accelerating that flow, not reversing it. The lower the paper price goes, the more metal transfers from people who respond to paper signals into the hands of people who respond to physical reality. One final connection I want to make today, because it links the jawboning of the oil market to the silver market in a way that mainstream financial analysis hasn't put together yet. Iran's official statement didn't just make a vague accusation. The use of language like firms hired to influence futures suggests Iranian intelligence has specific information about who is operating these positions and why. They're not describing manipulation as a theory. They're describing it as an observed, documented phenomenon they're actively tracking, with the same specificity as a military analyst tracking troop movements. Now consider what the silver market manipulation this channel has documented actually looked like. J.P. Morgan's precious metals desk was federally convicted of wire fraud and racketeering for spoofing silver and gold futures over a decade. The specific technique was placing large orders with no intention of filling them, moving the price in the direction that benefited the desk's existing positions, then canceling the orders once the market moved. That is in the federal court record. It is documented behavior by the largest custodian of COMEX silver. The infrastructure that executed that manipulation didn't disappear when traders were convicted. The capability exists across the industry. The JP Morgan case revealed one instance of a capability that operates wherever large paper market participants have both the technical ability and the financial incentive to influence short-term price direction. When the Iranian parliament speaker says they see the firms hired to influence oil futures, and when we have federal criminal convictions of the exact same technique applied to silver futures over a decade, the connection isn't conspiratorial. It's documented fact meeting an informed public observation about identical behavior in a parallel market. Same playbook, different assets, same institutions. The only meaningful difference between oil and silver in this context is that oil has geopolitical actors like Iran with national security reasons to publicly name and resist the manipulation. Silver has no such institutional champion. The manipulation of the silver paper price is contested only by the physical market dynamics, the vault data, the delivery mechanics, and channels like this one explaining the data to people who need to understand it. The jawboning of oil markets and the jawboning of precious metals markets are not separate phenomena. They are the same institutional capability applied to assets where paper supply can be manufactured far faster than physical supply can respond. And the response to both is the same. Hold physical, understand the data, recognize the performance for what it is, and wait for physical reality to override the paper performance. The Turks in Kayseri understand this. The Singaporeans who emptied dealers' inventory understand this. The Indians who bought every dip understand this. The institutions taking physical delivery at COMEX understand this. The people who sold at $61.76 learned something expensive yesterday when the paper price recovered 30% of the correction in 2 hours on a single social media post. Those people will not make the same mistake in the next jawboning cycle, and there will be a next one. The question is whether you've internalized the pattern before it repeats. You cannot print gas molecules. You cannot print physical silver ounces. The vault is at 332 million ounces and declining. May 1st notice day is 37 days away. The registered pool is at 79 million ounces against 350 to 380 million ounces of paper exposure. The Iranian parliament speaker has named the mechanism publicly. The Turks are in line. The physical buyers across Asia, Turkey, India, and Singapore are making the same decision at the same time for the same reason. The paper price is a temporary performance. The physical reality is permanent. The screen is not the reality. The vault is the reality, and the vault keeps draining. Bullish or confused, one word in the comments. I'm John Ag. I'll see you in the next one.